Welcome to the Financial Armor Show. My name is Brad Cooper, the CEO and president of Cooper Financial Investments. I want to welcome Tony Shore, my co-host as always. How you doing today, Tony?
I am really good today, and you
Yes.
know why. Our viewers can see why. We have a very special guest, and for our listeners out there, they'll hear why in a moment. You got an A-lister again. This is a
Yes.
great get for you and for the show, Brad. But I've been
Who's
great.
coming, Brad Pitt, did you say? You said Brad.
No, that's Ed Slott, our A-lister guest,
Yes.
Brad Pitt. I kind of look like Brad Pitt if he really let himself go. That's what I tell people. Well, Brad, how have you been?
Doing great here in hot Arizona, but it's a dry heat, so it's not so bad when it gets to be about 118, 120 degrees. But doing great. It's been a busy summer, and I am so excited to talk, today on the topic we're talking about, and with the number one expert in the United States, because that's been the talk the last month and a half as far as how is this going to impact me, Brad. And so very excited about that. So that's a good lead in to our guest. Ed has been on here before, but I want to introduce Ed. I've known Ed for several years, and I've been very blessed to be part of his organization, chosen as an advisor who is trained under him and his leadership. Ed has probably the last 30, 40 years, even though he doesn't look, that. He started when he was, 5, 6 years old. Is the number one IRA expert, in my opinion, tax expert, estate planning expert, been on public TV for the last several years, educating Americans. And to have Ed in his office as a resource for our clients makes me very confident, more so than ever, as a financial planner, a financial advisor, when it comes to the topic of taxes. And Tony, it seems like we talk a lot about taxes on this program.
We do.
But we're going to talk more today. But if you want more information on Ed and his most recent book published last year, The Retirement Savings Time Bond Ticks Louder. And it will give you an update on where we're at today, even though he probably needs to update it after the last couple months.
Sure.
And some of the changes, but good changes, which we're going to talk about today. So Ed, thank you so much for being on our show today and reaching out and educating our clients and our listeners.
Well, it's great to be here, and I'm glad to hear two things from you, that you talk a lot about taxes, because most advisors don't. Most advisors are trained to make you money. That's all well and good. But since most of that money is sitting in IRAs and 401ks, you have to deal with the taxes. Otherwise, you will lose a good chunk of it on the way out. It's great to make money, but the key with IRAs and 401ks is keeping it protected from taxes. And the other thing, mentioning that you're part of our elite IRA advisor group. It is a select group of advisors around the country that are focused on the education, on the tax planning around retirement accounts. It's a very focused group.
Yes.
There's an old saying, the definition of an expert is somebody who knows more and more about less and less till they know everything about nothing. That's kind of our group.
Yes. So true. And, our lead conversation and education, along with every risk out there as far as financial planning for retirees, is taxes. And, we got some good news partially from what just happened in the last couple months. And, on a daily basis, Ed, I'm getting asked, Brad, tell me more about this, new bill that passed. And how's it going to impact us? Are we going to have to pay taxes on Social Security anymore? Are we going to, are taxes permanently going to stay down low for the rest of my life? Do I need to do Roth conversions anymore?
Yeah, so let's talk about as the media has reported, the OBBBA Act, One Big Beautiful Bill Act, has ended taxes for everybody. All right, that's the media.
Newsflash.
Yeah, right. No taxes anymore.
Whoa.
So there are things in the bill that are not as they were advertised, let's say. For example, first of all, generally, there's something for everybody in this bill. It really is a mammoth bill. And as far as the tax provisions, I think there's a benefit for everybody who has income, who's working, has retirement savings. A part of it is the Social Security thing you talked about.
Right.
But that's, let's start with that one. That's an extra senior deduction, which is in effect now. You get that this year for 25. And here's the thing with these provisions. You really, this is why they need you, Brad. The provisions are all over the place due to all these budget gimmicks. In other words, they have different effective dates. Some are already in effect. Some don't go into effect till next year. Some end in 28. Some end in 29. Some are permanent. Some are existing items that are just enhanced. So you have a mix of a lot of balls in the air, and to figure out which benefits you, you can't do it in a vacuum. You got to look at the whole picture. When I see all these competing provisions, and some people can get a lot of them, some of them, none of them, it's almost like a whack-a-mole game. That's I think tax planning has devolved into whack-a-mole. Let's say you get one, but then you lose the other. Something else pops up. Oh, I like that over there. I'm going to go for that. Well, then you lose this one. So you really have to have a big picture. So before we get into this, you always have to keep your eye on the ball. I noticed this as I was writing up, and me and my team, you know, our team, Sarah, Andy, and I, and as we were writing up your huge manual for your next meeting, and we were getting caught in the weeds, and we had to step back and say, wait a minute, let's stick with our big picture, what people need to focus on. Yes, there are provisions here, but if you pan the camera back, and this is the way I always talk to clients, right at this same desk for always 40 years, what do you want to accomplish? In other words, planning with the end in mind. Not what do I get today or tomorrow or next week or next year. Where do you want to end up? Stick to the big picture. And in the big picture, one of my always rules, which we beat into you over the last 20 years, and you'll see it again in our technical manuals, my secret rule to always saving the most in taxes, I call it my always rule. Always pay taxes at the lowest rates. You'll always keep more of your hard-earned money. Right now are the lowest rates. I mean, we have, and they're extended. That's another big provision, but and extended permanently. But let's take a step back from there. The word permanent, I looked it up in the dictionary. And it means something that doesn't change. There's even a noun version, perm, you don't touch your hair or something. But the word permanent means unchangeable, it's forever. But in tax code, permanent means until Congress changes the rules again. As a CPA, we've always had this saying, tax laws are written in pencil. So things can change. But I think the good news here is I think it will be somewhat permanent, maybe indefinite might be a better word. For the next few years, we're going to have low rates. This is a great thing. More opportunities to, again, stick to the big picture planning, getting these large IRA balances down while rates are low, moving them into Roth conversions, life insurance, tax-free vehicles. That's where people want to end up. The last thing that I have, and this goes back years of planning with people that are watching right now, they don't want to worry about taxes in retirement if they can do something about it today. And if you can take advantage of today's low rates, you'll be in a much better position in retirement, even if rates go back up by then. So that's the big picture. Now we'll get into the provisions and see where they come into the big picture. And the best example of that is what you referenced, Brad. It's actually called the deduction for seniors. It was promoted as no tax on Social Security. It has nothing to do with Social Security. There are two separate provisions. Two apples and oranges. I'll give you an example. Let's explain it's a $6,000 deduction you can take, whether you itemize or not. So it's not a bad deduction, $12,000 a married couple. All you have to do is be age 65 or over. So that's a pretty good deal. But the income levels are kind of low, relatively, 75,000 for a person, 150 married joint. And at those levels, the best bang you'll get for the 6,000, the highest bracket you'll hit is around 22%, so maybe 1,300 of actual tax savings on the 6,000. And that's if you stay in the 22% bracket. So here's where I talk about the big picture. If I were talking to somebody, I know I'm talking to somebody out there has a large IRA, maybe too much in the tax deferred, a tax bill waiting to happen. I might say, you know what? I might concede that 6,000 to convert
Right.
more in the 24% bracket. So I saw an article actually a couple of days ago in one of the financial professional magazines or websites, and they have these, clickbait headlines. The $6,000 trap or something, that people, if your income goes over, you lose the $6,000 deduction. First of all, it's not. The deduction is 6,000. You don't get $6,000.
Right.
It's a deduction at relatively low rates. And before, I said it has nothing to do with Social Security. It's a deduction below the line, which means it reduces taxable income, not your AGI, your adjusted gross income, which is the key number on the tax return. It reduces all taxable income, nothing to do with Social Security. Even if you don't have Social Security, I'll give you an example. You have somebody out there, 68 years old, and smartly, I think they said, you know what, I don't want to collect till my Social Security benefits till I'm 70 to get a bigger check for life.
Right.
Well, that person still qualifies for this deduction if they're under the income limits, even though they're not even getting Social Security. Or on the other side, let's say you have a 63-year-old and they are collecting early. Maybe they need the money, health issues, whatever reason they're collecting early. They don't get the deduction because they're not 65,
Right.
even though they are collecting Social Security. So one has nothing to do with the other, even though in the promotion of it, they were tied, no tax on Social Security. The tax break is there. It's an actual deduction against all income, whether you're receiving Social Security or not.
So true. I just had that conversation last week, Ed, with some clients, and after going through everything and having our CPA team locally here involved, we decided not to, keep under the 150 mark joint filing, and
Right.
they see the bigger picture. But what I see on a daily basis, which I've been doing this for 31 years, Ed, is seeing our industry as a whole, CPAs, financial planners, not even bringing up this topic as far as taxes. And lately, I just had a meeting a couple weeks ago, and this person, I don't know if you ever had an appointment like this, Ed, in previous years when you were practicing, they were so focused on getting that extra return on their money, that extra 2 or 3 points, and lost sight that they had $2 million of IRA money, and they had no clue what a required minimum distribution was, much less that they have to take it.
Yeah, and that's another thing in the big picture of planning. People who wait till age 73 because they're not required to take it yet. Meanwhile, you're blowing all the years of low brackets. Never, here's another, I call this a federal tax crime, wasting a low bracket. I've had CPAs come to me over the years at seminars and things, and they're all proud. They say, Ed, you're going to love what I did. I kept my client in the 12% bracket. I say, I'm sorry to hear that. You wasted the 22, the 24% bracket. If you don't use those low brackets, which we may never see again in our lifetime, we're going to have them for a few years, you don't get them back. And this goes back to always focusing on the big picture, minimizing taxes by using the low brackets and the low marginal rates each year. So that's the $6,000 deduction. It may work for a lot of people, but I wouldn't. Exactly what you said. I wouldn't say, I'm not going over 150 because I want that, $1,300 when you're missing the big picture. The other, a couple of other big things here, the SALT deduction. I don't know what it is. Do you have state tax in Arizona? I don't remember.
We do. It's very low compared to New York and Minnesota, 2.5% to be exact, flat tax.
Wow.
New York, New Jersey, California. I was looking at the high tax states. I never really did looked at all the states at once when I was going through all this, but I didn't realize Hawaii is one of the highest tax states, 11%.
Yeah.
Wow.
I don't know. You got to do a lot of, I don't know how you do all the surfing and pay 11% tax.
Yeah.
Anyway,
that's tough.
for those in high tax states, though, And you know what? It's not, it's SALT. It's called state and local taxes, the SALT deductions. A big part of this bill
Right.
used to be limited to only 10,000. Now you're going to go up to 40,000. But even if you, like Brad, you say you're in a relatively low tax state, but it's also property taxes too.
Yes.
So other things get in there. So in the high tax states, what happens is you get into the club. It's like, the gold card. You get into the itemized club. Getting that big deduction can get you into itemized territory. That's going to be a change for
Right.
people in high tax states. Before this, about 90% of people used the standard deduction because it was higher than itemized. May go the other way now. So that could help a lot of people, but you got to watch it. There's a trap there too. Everything has a trade-off for all the budget gimmicks they have. Whatever they give you, they take back. Like I said, there are income limits where you don't get it. This one happens to have a very high income limit. You get it up to 500,000 of income. AGI is income, adjusted gross income.
Wow.
And it phases out at 600,000. But there's two little traps here you have to look at. There's a marriage penalty. The 40,000 is per couple, and so is the 500,000, where two individuals could each deduct 40,000 if they filed as two single people. So that's one thing. And the way they phased it out, it goes off a cliff, so to speak. As you get into that 100,000, if you're between 500,000 and 600,000, believe it or not, the effective rate due to phase out of losing that extra 30,000, where it goes back to the 10, is 45.5%. Because what happens is for every dollar you go over 500,000, you lose 30% of that extra 100,000. So the 30, eventually when you get to 600, you lose the 30,000 increase and you're stuck with the 10,000. Losing that $30,000 deduction now, the increase in the deduction from 10 to 40, puts both married and single, because it's for both, into a 35% bracket. And so you take that 30%, I'm just giving you the math, it ends up in that bubble, 45.5% effective rate in that bubble. So what happens is, see, that's an area you might want to sit down and say, that's a big deduction. Maybe I don't want my Roth to push me over 400,000, a Roth conversion. So that's one there. But there's also, I don't know how far into it we want to get, but there's also a workaround. I don't know if you've worked with small businesses. Have you heard of this
Yes.
pass-through entity tax? It's been around for a while. Once in the Tax Cuts and Jobs Act, when they lowered basically eliminated itemized deductions by capping SALT deductions at 10,000, states found workarounds to it, where you could actually pay your state income taxes on your business income through your business, which is a fantastic provision. But when this bill, just before it came to the Senate, the House bill had knocked that strategy out. They were against it. But somehow the senators took that provision out of the bill, and quietly that was the bill that was passed into law. So I call this silence is golden. The fact that they took it out, to me, green lights it, gives it the thumbs up, the okay. So you may want to talk to your CPAs or tax advisors if you have a small pass-through business like a S Corp, an LLC, if it's taxed like a partnership or partnerships, and you could deduct the state tax right off your business income, all of it, no, unlimited. It's almost too good to be true, but you have to check each state. This is a state law provision. I checked as of July 4th of the signing of the bill, 36 states allow it, but they each have their own regulations when you have to file for it and like that. So, but if you can get that, this is an unbelievable provision, because now it lowers your business income. It can lower your self-employment tax, your additional Medicare tax. But here's what I call whack-a-mole. If you lower your business income, you're also lowering your qualified business income deduction. But if you lower that, now you have room for Roth conversions that can pick up the qualified business. One thing leads to another. It's like a pinball machine.
And I would assume there's no minimum age requirements for the SALT deduction, correct? Ed?
No age. Anybody who pays tax, but it's only around for 25 to 29, and it
Yes.
has high income limits. So most people might get the 40,000, which opens up the door for itemizing and getting more deductions in. Once you get in the club, it's like it gets you membership into the itemizing club. Once you're in the forum, in the club, well, then you can add your mortgage interest, all the regular things you never got tax benefits for, your charitable contributions, medical maybe
Yes.
if they're high enough. So that could really make a difference for some people. Those are the two biggest items. Yes, you have the deduction for tips and overtime. But again, they are not what they're called in the law. In the law, that provision. I'll give you an example for tips. This is the actual law. This is. I don't know if you could see this, but you see what the law is.
Yes.
That clear? The part
Yes.
I highlighted. What does that say?
No tax on tips.
Yeah, that's not what this does. It's called that in the law, but that's not what it does. Another one here. This is the overtime provision in the law, the title. Can you see the title?
No tax on overtime.
Yeah, that's not what it does. So
Wow.
so these are they're good deductions.
Yes.
But let's talk about the tips. If you work on tips and you report them, I'm not talking about the people who don't report them. I don't
Right.
think that happens. I'm sure everybody reports all their
Yeah.
tips.
Yes.
In the
Of
best.
course.
Yeah. But it's like the one with the senior deduction. It's a below the line deduction. It's a deduction against all income, but related to a certain amount of tips and overtime. Same thing with both of them, but there are limits. Those limits are pretty high, but you still have to include the income. Your tip income will be on a W-2 form, and you have to pay payroll taxes, FICA, and Medicare on it, like you always did. But once you do that, yes, you may be in line for a nice deduction that can reduce all taxable income. Same thing with overtime. So you just have to understand how these things work. The auto loan interest, I didn't even bother with because it's so out of. You can deduct $10,000. First of all, I looked at it. I actually saw an article on it because we were trying to figure out how would anybody under those income limits be able to afford a car that has $10,000 of interest on a loan. We
Right.
came up with one thing. The Cadillac Escalade, I think I saw, goes for $115,000. But you're unlikely to afford that if you're making, $50, 60, 70,
Right.
$80,000 a year,
Right.
unless you're just not a good planner or something.
Right.
So you might get something out of it. But again, these are all good things. They just might not be as good as you were told.
Mhm.
So true. As you're speaking and educating and what we do, I'm just reflecting back on my day-to-day, meeting with prospects and clients. And in my background, Ed, I think I may have shared this with you. In my previous life, was not financial planning services. And when I started this industry 31 years ago, I was angry. Why? Because not once did school or anyone in this industry ever teach me what I have learned from you the last several years. Your background is taxes, and that's you're the number one expert currently. Why is it, in your opinion? I'm changing topics a little bit,
All
but
right, yeah,
this is
let's
my
do it.
biggest frustration with our industry: CPAs, attorneys, financial planners. They don't have these conversations.
Well, they don't want to learn Russian. That's what it comes down to. Because look at the way some of this tax law, 24 pages of this are just to describe Trump accounts and so many ins and outs. It's like learning a new language.
Yes.
People got into this industry mainly to provide investment planning, never
Right.
thinking about the way out, only the first half of the game, the building, saving, accumulating, investing, not realizing, well, this money is forced to come out.
Right.
And they figured, here's what I found out, because I had the same frustrations, especially when the IRA rules came out, and I jumped on them when I was in my 30s. as of the '86 Tax Act, when all these rules came out. I said to myself, this is going to affect everybody, and nobody can understand this. Actually, then I said it wasn't Russian, it was written in Sanskrit. Because it's not even a language you can identify.
Right.
So I think a lot of these guys said, well, the CPAs will deal with it. The CPA said, oh, the financial advisors will deal with it. The advisors said, the attorneys will deal with it. The attorneys,
Right.
went around and round like passing the buck, because nobody wanted to get into this stuff and say, look what I can do for my clients. Do the whole job. It's like you're playing half of a football game and you go in at halftime, right? And
Right.
maybe you're winning by a lot. And you go in and pat yourself at the back, said, I've got all the money I'll ever need for retirement. And you think you're done. Meanwhile, the IRS, they're playing the third and fourth quarter. They're playing nobody, so they win.
That's
And
right.
most advisors are not playing in the critical second half of the game. Yes, it's important to watch your investments, but in the first half, you watch your investments on the way in, but on the way out, you have to have that expertise in taxes to manage the taxes on the way out. You manage the investments on the way in and the taxes on the way out. Otherwise, you could lose big chunks of all those gains. And I don't think most advisors want to learn all this. Even the CPAs, my colleagues, now you would think, oh, they're tax guys, they must
Right.
know this.
They
This
don't.
is even a subgenre, a subspecialty of taxes. For example, you go to a general practitioner doctor. He knows the basic stuff, but he's not a cardiologist or a neurologist. Sometimes you need a specialist. So it's even that for the CPAs. They don't want to look at specialized. They just want to do what they're doing, which doesn't provide the real value people are looking for. That's why I started Ed Slott's Elite IRA Advisor Group, only for advisors like you, Brad, and others that you meet there that really want to deliver on the tax planning. Because, the market goes up and down, and it goes down and it recovers. You get your money back. If you lose money to taxes, you're never getting that money back.
That's
That's
true.
a
Right.
one-way street. And that's
It-
why tax planning is so important. And the opportunities, look at this one big, beautiful bill act, lots of new deductions on top of the other provisions we've had for years. But you have to have somebody like you, Brad, that's willing to dig in on this.
And that's what keeps me going, Ed. And I know that's why you're, going 150 miles an hour too, because, it's, no one else is doing it. Very few are. And I'm very thankful just because of our relationship the last several years and the education that we have obtained and the support and the leadership. I just calculated a few weeks ago, about 67% of our clients, Ed, in the next 5 years will be in a 0% tax bracket. And you think they're going to care if taxes go up by then? No. But more importantly, a lot of our clients, whether they have a little bit of money or a whole lot of money, legacy is important. And when you get on that topic and passing down a taxable estate or a tax-free estate, that's huge, especially for
Right.
their children.
See, that goes back to what I said in the big picture, in the
Yes.
grand scheme of things, just what I always ask, where do you want to end up? Then we work on how to get there. And if that means paying some tax up front, and that's the only way to do it with large IRAs, get the money out while rates are low. But there's a lot of people who just cannot fathom the idea of paying a tax before you have to. And it builds and builds and builds. And now with the Secure Act, remember, don't forget about
Yes.
that. We had that a few years ago. That's still intact. The beneficiaries are going to get zapped with a giant tax bill if nothing is done. Doing nothing to me is not an option. If you're saved in a 401k or an IRA,
Right.
they're going to get wiped out in taxes under the 10-year rule, where all of it has to come out in a short window.
So true. Wow, time flies, Tony, so fast. And,
It does.
as we come to an ending, I just want to mention to all of our listeners who just got a lot of valuable information that could really change your life financially. We at Cooper Financial do a tax analysis report for all the people who come in our office. And if you want one personalized for you, reach out to us. But also, I am so excited. What you just heard from Ed in the last 30 minutes, so valuable. He's going to be coming out to Arizona in February of 2026 to talk to our clients and friends and the public, which is going to be a free event. And the
Wow.
timing of this is going to be so impactful because guess what everyone's scrambling and doing in February and March? Taxes.
Yeah.
So, but I would encourage anyone listening to not wait till January or February to do their taxes. The last quarter of each year, and I'm just preaching what you would, Ed, is
Nice.
the most important part of planning, because if there's any changes to be made, you got to make them by December 31st.
Yes, for the most part. People always ask me, you tie in a perfect thing. And this is the difference between the long-term saving lifetime taxes over the long-term big picture than 1 year. Around that time, I'd say around the second week in April, around tax day, April 13th, 14th, 15th, there's always these media outlets like CNBC. Oh,
Yes.
can you come on and tell us what can we do to save taxes? They're filing their return. How can they save taxes? I say, okay, I'll come on. And I come on and they say, Ed, they put the spotlight on. What can people do now to save on their tax bill? And I looked at the camera, I said, nothing. Nothing. That year ended. Unless you have a time machine, that year ended. The idea is to do planning for lifetime tax savings. And they're sitting there, well, what do we have him on for?
That's great. Well, we need to also remind our listeners and viewers out there, because this is a great resource. The Retirement Savings Time Bomb ticks louder, right? And that's a great book, Ed, a great resource for people, how to minimize that tax burden, avoid those unnecessary taxes. Get a copy of the book. It's a good one.
Well, I can give you a better resource right there, Brad Cooper. Just what he said. He's got the knowledge because he's taken training from us in the tax plan. It's not about investments. It's protecting what you have. And he's been doing this for years and years. And nobody can know it all. But he has direct access to me and my team of experts. Anything comes up, he's got the greatest back office in America on these IRA tax rules.
So true. And I'm very thankful. I want to mention this too. You saw the book. Anytime Ed comes out with a new book, we purchase in quantity. So every person who comes to our office, we give a copy of that. That's how valuable and the investment we make in our prospects and our clients for life. And that's the enjoyable part of it. So, but for more information, you can call our office direct, 888-390-5277, or you can visit our website, financialarmorshow.com. Again, that's financialarmorshow.com. And Ed, thank you so much for taking time out of your busy schedule. I look forward to seeing you in a couple months for a week's full of training and updates. And then if you're listening, reach out to us and we'll confirm with you the date that Ed's coming to Arizona, sunny Arizona, in February of 2026.
I'll see you there.
All right. Thank you.
Thanks, everybody.
Yeah, thank you, Ed. And listeners and viewers, thanks for tuning in. That does it for today's episode of the Financial Armor Show with our host, Brad Cooper, and our special guest, Ed Slott.